for them, price still matters. It's just like living in a place where the average home is $1 million.
Yeah.
You might have $200,000 in the bank, but you don't feel like sinking it into $1 million home.
Right.
It doesn't mean that you can't afford it. It just doesn't feel meaningful to you. There are thousands of other things that people can do with their money. And at the end of the day, these companies need to incentivize retail investors to believe in them.
Yep.
Welcome to the Rich and Regular podcast, where we explore life at the intersection of money. I'm Kirsten.
And I'm Julian. And today we are talking about stock splits.
Yes.
We've heard a lot about that in the news in recent months, it feels like. In recent years, it kind of feels like. So we're going to talk about that a little bit. But first, I want to give a shout out to one of our followers or subscribers, I should say, on YouTube. This is Shanrika. I hope I'm saying that right. The comment was in response to our latest episode of Money on the Table. I shouldn't say latest. I'm not sure when people will hear this one. It said, man, when y'all said you expected a 10% return, my eyes widened. We started investing in 2004, and coming from a background where investing was considered buying weekly lottery tickets, LOL, my expectations were low. I just wanted to beat high yield accounts. I had single stocks for a long time before transitioning to indexes, and that's been cake.
Man.
I think having a lower expectation in the beginning gave me the ability to really hone my skills and not be so worried about picking the winner. Investing is not gambling. Even when you're doing single stocks, when done correctly, your money will almost always grow. I think we might have even paid
Come
for
on,
that.
Shanrika.
That was great.
That's what I'm talking about.
Thank you for that.
Yes.
We support that comment 1,000%, not just in the context of that video where we were talking to a certain extent about the rise of high risk investing and gambling and those kinds of things. And so that was the comment to that. It's also relevant to the conversation we're having today.
Mm-hmm. Yeah. Like you said, there's been a lot of news about stock splits. Nvidia just did one. They did a 10-for-1 split.
Yeah.
Walmart just announced a 3-for-1. Chipotle just did one. Broadcom, which is another chip manufacturer, just announced theirs. Other companies like Amazon, Tesla, Alphabet, they all did theirs like in 2022, a couple years ago. But it's one of those questions that I feel like people are too embarrassed to ask about.
Yeah.
Like, I almost thought about making this a series called Too Embarrassed to Ask, or maybe embarrassed is the wrong word, too busy to ask.
Yeah.
Because you hear about it, you know that it's hyped up, you see a lot of the content, like, should you buy this? Should you buy this? And by this point, you've probably learned to ignore it. We are adding to that to some extent, but we're going to try to explain it in a way that helps you understand and put it in context. So if you do want to add it to your investment portfolio, like, you at least have the background on what it is and what it's not.
Yeah, it's one of those things which I think are pretty common when it comes to investing is you see content about one thing, but in order to understand that thing, you need to understand like 6 other things.
Right.
And so you see it, you feel like you should understand it, especially if they're talking about a company or a brand that you recognize. It's like, all right, there is some kind of understanding here, but everything else just sounds like gobbledygook. I have no idea what this stuff actually means. So we're going to talk about that. Go ahead.
I was just going to say, bring back gobbledygook. I haven't used that in a while.
You know, I think I've just been trying to use more corny language lately.
Why?
I don't know. It feels cool. I'm like entering into my dad era.
Your gobbledygook
My
era.
gobbledygook. I might throw a malarkey in there or something like that. Like, yeah. Okay, so a stock split. What is it? It is exactly what it sounds like. You're splitting your stock, but let's break that down a little bit. So let's say you owned a share of a stock and the price of that share was $1,000. You had one share is $1,000. You own $1,000 basically of value of, share in this particular company. When that stock splits, or if that stock splits, instead of owning one, assuming this is a 2-for-1 split, you now own 2 shares. And instead of them being valued at $1,000, it's now being valued at $500, right? So your total value in terms of what you own does not really change, but now you own more of it, which is why they call it a split. 2-for-1. You mentioned it earlier. Some companies have done 3-for-1. You mentioned Chipotle did it at 50-for-1 stock split. And so companies can decide to do this based on whatever their objectives are. I think a interesting way, obviously I'm a foodie, to think about it is to think about a pizza. So you have a pizza, and depending on the size of the pizza, I think most normal pizzas are cut into like 8 slices or something like that. If a smaller one, maybe it's 6. But let's assume we're talking about a pizza that is cut into 8 slices. And if you take that pizza and you just kind of comb through or cut through those slices again, you, instead of having 8 slices, you have 16 slices. You still have the same amount of pizza.
Yeah.
Right. But
it stretches a little
But
longer.
if you were trying to, let's say, buy a slice, you know, and shout out to my New Yorkers out there, because this is still like shockingly not a thing down here in Atlanta, but like you can buy slices of pizza in New York. And I don't know about other places like that. I think Chicago, you know, I get sidetracked talking about food. But anyway, you can now, let's say you couldn't really afford, or like buying that whole slice of pizza was like a little bit of a stretch. Now it's a little easier for you to do it because you can just buy a half or slice, but you're not getting half. Like you're just getting your fair share of pizza, and it's more affordable because before it was only available in eighths.
Yeah.
So that's basically what a stock split
It's
is.
like the difference between a regular pizza and your class party pizza. You remember when you used to have pizza parties at school and them slices would be thin to make it stretch?
Yeah, you're right. Listen, yes.
It wasn't no full piece. You still got 2 pieces, but it's really just the equivalent of 1 slice.
Yeah.
There's not more value being added because you can now have 2 pieces.
Yeah. Yeah. I remember the trick there was eat first. You got to get them out first. Get your little third of a slice of pizza so you can finish quickly and get back and see if there might have been a little extra little slice that you can go pick up. That's the only way to get up to a slice if that's what you really needed. But yeah, we mentioned Chipotle, and I'm going to bring this up for a couple of reasons. You mentioned it at the top. I mentioned it as well. They recently were in the news for doing a 50-to-1 stock split. In our investing class, we specifically refer to Chipotle because we had our own kind of element of FOMO with respect to Chipotle stock when the company first did an IPO. And I think there's still, to a certain extent, a little bit of regret about that. But we can talk about that till we're blue in the face. We wanted to play a little clip. This is from the Chipotle CFO. His name is John Hartung. I think I'm pronouncing that correctly. He was recently interviewed in response to the Chipotle 50-to-1 stock split. This is what he had to say in terms of why they did it.
Cost was never really a big problem for us, but we couldn't really find a compelling reason until recently. And there's 2 reasons really that led to this split. One is our employees. It was getting harder and harder for us to get the right denomination because we reward our top performing managers with stock in the company. We want them to celebrate our success with us. And it was getting harder and harder where if you wanted to reward a manager with $4,000 worth of stock, you'd either have to award $3,000 or $6,000. So that made it a challenge. And also when their stock would vest, the withholding made it tough too, because the withholding could only happen in full value shares. And so if you had, let's say let's say you had $3,000 worth of value that was created, the only withholding you could accomplish was 1 full share, which basically would wipe out most of the value. And so for that reason, that was a big reason for us to do it. The second one, though, about a year ago, our investors started telling us that separately managed accounts were a real problem to get liquidity. These accounts typically, I'm sure you know this, Jim, they tend to be small. They tend to be in the 50,000 to 100,000 range. But in total, they're the fastest growing investment class. And they total now over $2 trillion. So it's a lot of small accounts that add up.
All right. So that was the CEO, Jim Hartung, on Mad Money with Jim Cramer talking
CFO
about
or CEO?
CFO, excuse me. He's the CFO. But CFOs really know. They run in the show. Shout out to the CFOs out there. But he gave he gave 3 reasons really. So the first one was basically employee incentive programs. I think you're going to talk a little bit about that too. He referenced to kind of like a 1A to that, but like you offer these incentive programs for those who get like stock as a reward or an incentive or a form of compensation. But then you, in some cases, have the ability to write that off, but that becomes a little difficult when the stock is valued or structured the way that it is. And then the third one, or the second one, was really around just the
Retail
availability investors. And the people who have smaller sort of brokerage accounts. And I think that's probably the number one reason. I thought it was interesting that he flipped it a little bit. I was like, okay, like, well played.
Played.
You're on CNBC.
Somebody went to media training.
To an extent, to an extent. But yeah, okay.
Yeah, there are a number of reasons a company would do a stock split. The employee incentive alignment is one of them. It is very difficult when you have a really high stock price, and that's what's motivating your executives, and that's what's creating all this top-down excitement, but it doesn't translate to frontline employees. If they're
No.
having a terrible experience at the store, at the brick and mortar version of whatever, or their workday is horrible, then they don't feel the same. So when you lower the price of the stock, they can now participate, which aligns their incentives with the company incentives, which
Yeah,
is
if you've
nice.
ever been that person, and I certainly have been in the room when these kinds of conversations were being had, and it felt like, you talk about frontline employees, but even if you aren't in a frontline, let's say you're a Home Depot employee working in the store or something like that, even if you're a corporate employee, right? Sometimes if you aren't a person, let's say you're a lower level manager, you're climbing the ladder, but you just haven't unlocked that as an incentive. When you hear that the directors and the VPs and the executives talking about this as if it's something that's relevant to you, it always seems a little tone deaf to me.
Yeah.
And so something like this, I think, to your point, I think makes it feel like, oh yeah, remember, this is a reason to stay. You too may soon have access to this. So keep your eye on your KPIs and those kinds of things. But yeah, it's a ficky kind of like remix on the issue. But I think, to your point, the larger issue is that it makes it generally available to the vast majority of people who kind of suffer from that same issue. They want to be able to buy the stock, or maybe they're interested, but they can't if it's valued at like $1,000 per share.
Yeah, Chipotle was like $3,000
Yeah, it was
a share.
something crazy.
I mean, when you think about people's paychecks, it's like if you spent a whole paycheck and you only got one share, it's hard for that to feel like a meaningful investment. Now, on the other hand, the point that he really made is the one that is the real reason. And very few CEOs will admit this. Nvidia CEO Jensen Huang said it. But the reality is these companies recognize that retail investors is an up and coming and very important class of investors. These are people with a smaller account balances, but they still actively move markets. For them, price still matters. It's just like living in a place where the average home is $1 million.
Yeah.
You might have $200,000 in the bank, but you don't feel like sinking it into $1 million home.
Right.
It doesn't mean that you can't afford it. It just doesn't feel meaningful to you. There are thousands of other things that people can do with their money. And at the end of the day, these companies need to incentivize retail investors to believe in them.
Yep.
That's why they do these stock splits, because it changes, in theory, the market perception.
Yeah. It creates a flurry of interest, in theory, right?
In theory.
I feel like that's going to be like the second of maybe 100 times that we say this, but like that is in most cases the reason why they do this. They want to generate buzz.
Yes.
They want to get people excited. They want people to jump in. And obviously there's always going to be a difference between perception and reality. Going back to the top of this conversation, I actually asked Google Gemini, because I was like, I'm sure AI would be able to pull this together, because it does seem as if we've seen a flurry of stock split announcements. I think it's really just a byproduct of us being in a pretty healthy stock market environment where you've seen a lot of growth and people want to do whatever they can to kind of keep this thing going. And I was asking Gemini to see if they could tell me, like, are we in a peak period? Like, is there data to show when there have been a lot of stock splits? And it didn't really give me an answer. It was like, well, there's no data on that. I find that surprising. I'm sure there's data on that. I'm sure there's a white paper. I only spent like 20 seconds doing it because I wanted to have a little tidbit. But all of that to say, it's supposed to create a bit of buzz, a bit of excitement, to send a signal basically to people that the company are confident in their ability to kind of run it up again. But it doesn't always work that way. I think in some cases, I would say in most cases, and I'm speculating here, but I think it ends up being a bit of a mixed bag in most cases, because at the end of the day, it, like we said with the pizza or any other way that you want to slice it, it does not change the underlying fundamentals of the company. Like what makes a stock grow in the long run is going to be the core business. Do people like the product? Does the company do a great job of selling and driving revenue, creating profit, managing their costs, and those kinds of things? A stock split is not going to do anything like that. If anything, it's going to create a bit of a temporary buzz and maybe kind of soften some kind of metric that they're looking to soften, or maybe wipe away any kind of, issues, or create a little bit of a distraction and those kinds of things. But ultimately, I think this is about like a short-term burst, getting people a little bit excited, kind of tickling the emotions a little bit of prospective investors out there. And to your point, there are people who, you mentioned the idea of living in $1 million home. Yeah, it is a big ask to sort of dump everything into one share. There are people, and certainly there are reasons to say, yeah, I want $1 million, but I don't want $1 million in one thing.
Right.
I want $1 million and I want to spread it out a little bit because it gets a little scary after a while. Because if something goes wrong, it all kind of goes away. And so there's certainly a investor psychology element to this. But ultimately, these are the reasons why companies do it. And there are also some things that I think it just flat out doesn't do. And I think that's the most important kind of other side to understanding what a stock split is.
Yeah, I'll give an example of what companies are thinking, and then we can talk about what the market is thinking, because those are two different things.
Okay.
What companies are thinking is that when you announce a stock split, it creates this increased trading volume. And increased trading volume is just the word that they use when a bunch of people are coming in and buying and selling shares. It creates more activity in the market. And when there's more activity in the market, there's more liquidity. And you heard the Chipotle CFO mention this. There's more liquidity, which means that people can easily buy and sell their shares without affecting the stock price, which makes it very enticing for an investor because it allows you to draw from your investments without hurting yourself down the line. Now, as people buy and sell more shares, it also creates more demand. When there's increased demand, this is economics 101, the price tends to go up. When the price tends to go up, the company makes more money for its shareholders, it takes more profit, and that's how people end up on the right side of the equation. If you think about this like a bakery, I know you use your pizza analogy, but I'm going to go with a bakery. If you were a bakery that only sold whole cakes, but the price was so high, so only a few people could afford them. You can think about nothing bundt cakes. That's not a great example because now they sell the mini cakes, but it's still a whole cake. That's actually a great example. A stock split is a mini bundt cake from Nothing Bundt Cakes. Those who know.
I was about to say, now you're going to run into the issue of a lot of people not knowing what Nothing
The point is,
bundt cakes are.
If people can't afford a whole cake, only a few people buy them. But if that bakery starts selling slices of cake at a lower price, more people can afford to buy some. That increased demand for cake slices helps the bakery overall, which means that they can probably raise the price a little bit and start to get even more profit, which is what the companies are thinking. Now, to your point, this is a double-edged sword because one, there is speculation versus fundamentals. Just because something is affordable doesn't make it a good investment. Just because a company does a stock split doesn't mean that they're completely healthy. They're just trying to create the perception that they are. It's like putting lipstick on a pig or, whatever the phrase is. The other thing is just around investor psychology and market sentiment. I think we talked about this a few weeks ago, but the majority of Americans believe that the stock market is actually down this year. They are not bullish on stocks. They're not understanding what's happening because they don't feel it in their wallets. The inflation that they feel is more important than whatever they're hearing on the headlines.
I think also people use the word economy and the stock market kind of interchangeably.
Exactly.
You know what I mean? And so to your point, like what they feel is the effect of the economy and a combination of maybe, let's say, like the labor market, but like that, it works independent. I mean, I'm not going to say independent. It's not disconnected. You should say they're related, but it works and operates independent of the stock market.
Correct.
And we saw that during the pandemic. We don't need to rehash that, but things were pretty bad in the economy. The stock market was booming.
Yes, exactly. So announcing a stock split is like announcing the Christmas party after a round of layoffs. You know what I'm saying?
Exactly.
Or asking people to cheer up during a hurricane. If they're not feeling it, they're not feeling it. And if no one buys, that's not enough to lift the share price of that individual stock.
Right.
The stock split is just over there stock splitting. And so what we're saying is there's a lot of things that a stock split is, but it is not a money-making machine. It does not change the overall value of a company. It is not something that suddenly makes your shares more valuable. It just makes them easier and more accessible to a different type of investor.
And I'm really glad you said that because it gives me an opportunity to jump on a soapbox for a little bit. What you just said is so important because that's not what the internet would suggest, right? Like if you are the kind of person who, to your point, may have been a little bit embarrassed or discouraged to ask, and you saw it, maybe 2 or 3 people, and maybe you mentioned it or you watched a little clip on CNBC and you was like, let me go back to watching Bridgerton or Money on the Table. Shout out to us. My point is, the way that it's presented on YouTube and in the media is like, this is a great thing. This is a big thing and big news. And it was like, yeah, it's important. It's relevant for people who are invested. It's something to take note of, but it is not a guarantee. It is not an opportunity to buy. I don't want to say it doesn't mean anything, but it's certainly, if you look at the way that stock splits are mentioned, it's typically like, it's almost like an attempt to tickle the psychology a little bit, but then everyone, without question, because they know they'll probably get in trouble if they don't say it, it does not change the underlying fundamentals of the business. It doesn't mean that the company is doing any better. It doesn't mean anything really. It just means that, yeah, you still have just as much pizza. I'm just cutting it in half or in thirds or in 50 tiny slices.
Yes.
And it doesn't change anything. Like, you still have a slice of pizza. It's just cut up for you, know, and like, that's it. Like, that's it. It's a market manipulation phenomena, if you will. But even that is, I think, a little tricky to nail down, because nothing is really guaranteed. I mean, nothing was guaranteed before the split. Certainly not going to be guaranteed after the split.
Yeah. What we're trying to answer is, or what we're trying to talk about is, does it make sense for you, right? That's what we're trying to help you get to. And we can't tell you, girl, I don't know. Like, it might, it might, but we're clearly biased because we're not individual stock buyers. We don't really buy individual stocks. We have a few in our son's brokerage account. We have a few in our health savings account, which is our specialized investment account for healthcare. But that's because the goals and the investment horizons for those accounts are very different than our primary brokerage and our retirement.
But I would add one caveat, or a bit of a use case here. And this is not to encourage people to individually buy stocks, but let's say you were looking to just take on a little bit more risk. Let's say you were a little bit more of a seasoned investor. You've been investing in your 401ks and IRAs, and you did all the things, the 529s, you got a custodial account, you've checked all the boxes, you're doing well. And for whatever reason, you just can't scratch that itch, and you want to see if there's an opportunity for you to do a little bit more. You're flush with cash, you have consistent income, you're not really worried about future income earning opportunities, and you were looking for an opportunity to invest, and you knew that there were companies like an Nvidia, like a Tesla, and yes, you have coverage in them. You may have invested in them in an index fund or some other type of mutual fund, but you really wanted to carve out and maybe, let's say, take that 5% or that 2%, whatever it is that you've carved out for an individual stock. This might be an opportunity for you to say, you know what, now is the time for me to do that.
Exactly.
Because I don't know that this is going to happen, but I'm willing to take on that risk and say, you know what, in addition to these holdings that are incorporated into mutual funds, I think now's a really, really good time for me to dump some in an individual fund and see if this company has the potential to kind of do what they've done for the last 10 years, right? If you look at the rise of Chipotle over the last 10 years, it's been nothing short of remarkable. Assuming they can do that again, maybe they will, maybe they won't. Some people might say Kava has a better chance, or some other kind of fast casual concept. But assuming you're willing to take on that risk, I think a stock split creates a bit of an opportunity for you to do that. Same goes for Nvidia or something like that.
That's exactly it. And that's why I did procure some individuals in our HSA, because I've looked at the history. I've looked at our risk profile. I feel like we can take it. I know what the downside is. It's capped. We don't use that account. We're not reliant on it for our retirement or for our lifestyle. The point of that account really is just to try to keep up with the costs of healthcare and make it one less thing that we have to worry about in our future. I think you're right for doubling down on the incentives that people have for participating in stock splits and using them as an opportunity, depending on whether you're a short-term investor or a long-term investor.
Yeah.
A lot of short-term investors see the split as this opportunity to take advantage and trade on some short-term market movements, right? They're hoping to catch some quick profits from all of the volatility that it causes as the market adjusts. Now, long-term investors like myself are not necessarily worried about that and might just see the split as a chance to buy shares of a fundamentally strong company at a really accessible price. And so what we saw with Nvidia after the stock split, the stock declined because a lot of those investors that have been holding shares for 10 years
took it as an opportunity to kind of cash out.
To take some profit, right? They didn't completely cash out, but they certainly took.
They said, you know what? Let me go ahead and say this has been fun, but enough is enough. I'm going to go ahead and take what I can get.
Let me move some of this over here
out over a couple other things, right? Again,
which is my plan.
Hey, listen,
Yes.
I'm all there for it.
That is my plan. There's some really positive examples. Apple did a stock split in 2014, and it's often cited as a success story. That split helped more investors come in, which coincided with strong growth because Apple now had all of this money that they could create these products. Google, when it was called Google, actually did a stock split at the same time in 2014. A lot of people who bought Google stock in 2014 riding high. They had a rough 2022, but they're going good in 2024. And then there's some mixed and cautionary tales too. Amazon did a stock split in 1999. Shout out to 99. That was a good year. Amazon did a stock split in 1999, and it was great for a little while. There was some years where things were going up, and then they crashed, and investors had to wait 10 years before they got to new highs.
Amazon would have been an interesting stock to hold if you ever look at that max trajectory.
Listen,
do yourself a favor and look at that one and see if you've got the courage to hold on and see like, wow, this seems like this company is growing. It seems like they're doing well. How come the stock is just absolutely not moving? Like, it was intentional. It worked, but man, that could have went left.
It was a hard road for Amazon investors. And then there's some cautionary tales too. Like during the dot-com bubble, a lot of companies were doing stock splits to try to get some extra capital into their coffers. And when those companies went down, all of those investors, all of those shareholders lost that money. And so there is a mixed bag of results when it comes to stock splits, which is why it is so important to focus on the fundamentals and not just the hype.
Yeah.
Or just do what we do and index and chill. Like, you don't have to buy individual stocks.
Yeah, you don't. You do not have to fall into the hype. This is a really, really great segue. I want to go right back to the top because, again, we're talking about stock splits because it's in the news quite a bit, but also in response to our latest episode or one of our recent episodes of Money on the Table entitled Luck is Not a Plan. Because I think the spirit of that episode was just to remind people that, the fundamentals is what's most important. You cannot plan to get lucky. And we realize, as having had thousands of conversations with people about their investments and their futures, that a lot of us are just disproportionately relying on luck to be this magical thing that happens. Like, we all are kind of betting or hoping to have our own version of that story.
Yes.
And we use examples like some of the companies that we've mentioned as a rationale for why they're taking on this unnecessary risk. But to your point, the fundamentals should matter most. So if you want to carve out, I don't want to say an insignificant amount, but a small amount, a comfortable amount to kind of take on this risk, that's fine. But when that amounts for, I would be honest and say over 10%, really, like for the vast majority of people that I know, if over 10%, and some people we know 20, 30% is like in an individual stock or a collection of individual stocks, that is very, very risky. So if this was helpful, let us know by leaving us a comment or sending us an email. If it was helpful and you still want to learn some more, you like learning from us, you like learning like this, or I would say in an even better way, this is a great reminder and a segue that we do have a class on investing, a master class called Making Money Grow. We talk about individual stock investing. We talk about how to analyze companies. We talk about allocation, which is what's going to help you determine whether or not 10%, 5%, less or more is good for you, how you should go about approaching increasing or decreasing that allocation over time. But for right now, I think this is a good stopping point. We've been talking about pizza and baked
cake.
goods. And I think I got the grumbles going on in here. And so why don't you close this out?
All right, y'all. Thank you for listening to another episode of the Rich and Regular podcast. We're all responsible for shaping market perception. And the way we do that is through reviews. It's not a stock split, but it's equally as valuable. So if you like what you heard today, please take a moment to leave us a 5-star rating and review on your favorite podcast platform, or leave a comment below and we'll keep the conversation going. We will see y'all next week. If you like videos like this and want to see more, make sure you click subscribe and turn on notifications.